Good morning. My name's Jim Tietke. I am the Chief Sales Officer here at Alcivia. Want to welcome everybody. It's 11 o'clock, so we're going to get started with the program. So welcome to our Alcivia virtual grower meeting. Today we are focusing our topics around risk management. So you'll hear quite a bit about risk management in different areas, from the different product areas: agronomy, animal nutrition, energy, and grain. We've got a special guest, an agriculture economist. I'll have Jim Dell introduce Michael here in a minute. So we will go from 11 to noon here with Jim Dell and then Michael Swanson. And then we will go into the breakout rooms. You would have selected a breakout room for either agronomy, animal nutrition, energy, or grain. So you'll only be able to be in one breakout room, but the sessions are all being recorded, and so you'll be able to go on to the Alcivia website and watch the recorded sessions, and we encourage you to do that. Next week's session on the 10th will be basically the same agenda and the same presentations. So with that, I'm going to turn the program over to Jim Dell, who is Alcivia's CEO. Jim's been with Legacy Landmark starting in 2018. Has a long history in leadership of co-ops, and so we're proud and glad to have Jim kick the meeting off today.
Well, thank you, Jim, and I appreciate the introduction. First of all, I want to start out by saying thank you to all of our customers. We appreciate your patronage and continued business with you. Secondly, I'd like to thank all the employees that helped put this together. We got a really nice program lined out here for you all today, and I hope that we meet your expectations. As we move forward here, I do want to talk just a couple minutes about Alcivia, and then I'll move on to the rest of the presentation. But today celebrates exactly 1 year into our merger of these two wonderful organizations that we've brought together. We are in the process. In this next week, you as patrons will see our letters coming out about our patronage that we are going to be releasing. And that's 1.05% of your ag supply and retail business that you've done with us. And we'll be paying out $2.2 million in aggregate. And that's 100% cash payment to our patrons. Very excited about that. Last year was a bit of a tough year in our grain division. We will not be paying out patronage on that business. However, in May of 2022, you will receive a letter from us about our pass-through of Section 199 DPAD deductions. And that in totality amounts to over $6.4 million that we are going to be able to pass back to our patrons, or 18 cents a bushel for all the business you did with us that we purchased grain from you or you sold to us. So we're also very excited about that, as that's a significant dollar amount back to your tax side of the business. So with that, enough about Alcivia, and we're again very pleased to have you here today. And I'm really excited to introduce Michael Swanson, the lead economist for Wells Fargo, ag economist. I've known Michael quite a while, and we've shared a lot of stories together. So I think you'll really appreciate his approach to the talking about the economy and how it affects agriculture. So sit back and enjoy, and I'll turn over to Michael Swanson to let him introduce himself and move forward with the presentation. Thank you all.
Well, thank you, Jim. It's a pleasure to be on the call today with everybody. And I'll say up front, my favorite two answers as an ag economist is I don't know and I was wrong. And those are appropriate because we're talking about pretty complex guesses in the future. But we're going to talk a little bit more today about some of the structural issues that are coming our way and some of the opportunities I think that we're going to have to manage. I'm going to share my slide here so that we can talk to that. I mean, economists without slides, basically, that never works. So we're going to talk about, trends versus cycles, because one of the things I really think over time is that we have to understand where we're at. I mean, we don't want to, not understand, the opportunities in front of us. So what are we looking at right now and what should you be doing? I always ask people to really kind of split the world into two pieces. We live in a system, and I always define systems by the fact that they interact. If you change A, it changes B, but that's not the end of the story. There's never any happily ever afters in the economy. There just aren't, because B comes around and changes A again. That's what we call a closed loop. We are so familiar with these loops, we kind of take them for granted. Let's talk corn and soybeans. Here in the upper Midwest, corn and soybeans are our predominant crops. We're going to plant them, going to be a huge percentage of our acreage. You cannot change the price of corn without changing the opportunity for soybeans, and vice versa. As soon as you change soybeans, you come around and you change that opportunity for corn. Now, there's things outside of that loop that we're working with today, things like fertilizer prices. And we're going to talk about at what point do you shift the balance and how long does it stay out of balance before you correct it back? So when you think about a system, there's really two ways to think about that. One would be, you say to yourself, what's a permanent change? What's something that's just part of the world now? And what's kind of a cyclical transitory issue? For example, think about things, the elimination of demand. For example, take the dairy industry. People no longer are drinking bottled milk as much as they used to because they're drinking a lot of other beverages at home. So as you eliminate that fluid milk demand, the fluid bottlers have to deal with it, and then that affects the rest of the dairy industry. Is fluid milk demand coming back? I don't think so. I think with the alternatives and other beverages, they have to see that as a permanent shift. How about things like ethanol? Ethanol came into the scene. It was a major issue for us. We kind of formatted the gasoline supply to accomplish with the 10% demand structure. That was kind of permanent. But once again, technology can come along, battery technology, and steal away some of that change. So permanent is kind of one of those words you use with great caution. Anything more than 5 or 10 years is permanent as far as most people are concerned. How about the Ukraine-Russian conflict? Just a terrible humanitarian issue right now, and we all regret to see what's happening right now. But is it a permanent change? Does it really change the structure of the global demand or the global supply on a go-forward basis? That's a different question, and you'd have to kind of work your way through a list. Does this mean that certain ports will never be used again? Will certain ground never be available again? Things like that, is that more of a cyclical transitory issue that's going to have to be dealt with? So we kind of split the world into these two pieces, structural versus permanent. Now, it's very important for us because when we think about this, some of the things that you're doing as a group that's most important to you, and we'll talk about this, is purchasing land. Purchasing land is not a transitory issue. Typically, it's a multi-generational investment in many cases where you're going to hang on to it for 30, 40, 50, 100 years in some cases. And so when we think about that, we're dealing with these issues on a go-forward basis. So we're going to use this trend or use this framework of permanent versus transitory and think about how we're dealing with it. So one thing I also want to communicate is we look at a lot of what we call time series charts. We look at them all the time. The price of corn over the last 15 days, over the last 15 years. fertilizer prices, stock prices, interest rates. We're used to looking at what we call time series charts. And as the name implies, it's something you track over time. Now, I want to make a point here. If nothing else, just get out your piece of paper. I know you guys have a notepad next to you. And write down these three things. We always break a time series into three pieces. You have a trend. Either it's trending down, trending sideways, or trending up. And around that trend, you can have cycles where it goes above or below that trend line. And then there's random events, things that happen that move it either above or lower, but it's not something that's very permanent. So starting with agriculture and talking about where you want to put your money, put your focus, what do you want to be good at on investments and risk management going forward, let's start with demand. Well, people eat. I mean, we're in this business because people eat. But how many people there are is not a constant. And in fact, the rate of change, as we're seeing in this chart for our most important market, United States, is certainly not constant. What we're looking at here is something that should give you pause as a strategic investor. We're looking at the rate of population change, the growth. So we've only had growth in the United States. But when we look at this chart, we can see the year-over-year percent change. Now, if you looked at total population, it goes up, 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 up. But what we're hard to see when you look at that total population is how fast or how slow is it changing. It's very difficult for the human eye to really make that connection. But this way, we can see very clearly that the rate of growth in the US population is slowing. Now, around that slowing trend, we've had a bunch of cycles below and above. But right now, we're well below average. We're at 0.4%. COVID did a couple of things. One, it slowed down immigration. That was the biggest piece of the slowdown. And people maybe put off having families over the last couple of years. So we've seen a very, very reduced population growth rate. So we're in the food business. We're in the agricultural business. So if our demand base isn't growing as fast as it used to, we should be asking ourselves, what does that mean to me? And what does it mean to my markets on a go-forward basis? Well, it's pretty obvious. Given the fact that we're all going to adopt the best technology because we compete on yield, we're going to see more of a push to global markets. Let's bring back in the Ukraine-Russian conflict that we're dealing with right now. As we push more and more of our product into the international markets, we become more and more susceptible to exchange rate issues, sanction issues, things like that on a go-forward basis. So this is an important part to our world. How about the money piece? Let's talk about the domestic economy for now. Let's talk about GDP. GDP is one of those acronyms that we always hear about from economists. But what does it really stand for? What does it mean to us in the ag sector? So GDP stands for gross domestic production. It's the goods and services that we produce over the course of a year. Now, those goods and services are kind of broken down into bigger buckets. The first bucket, and the biggest one to us, 70+% of GDP, is personal consumption. And personal consumption, of course, gets broken into other buckets. It gets goods and services. Services, whether it's medical, education, whether it is things like that, or it's goods. It could be new cars, it could be new houses. So we have all sorts of pieces within that. So we have personal consumption. Then we have business investment. And as I know, the people on the Zoom call today are a big part of business investment. When you buy a new tractor, when you build more bins, when you do one of those things to enhance your productive capacity, that is a business expenditure. And that's a big part of the economy as well. Another big part would be government expenditure. Government expenditure are basically exactly those things that they buy, building roads, buying inputs, things that they have to buy to run the government. Now, just a little nuance here. When they deduct a lot of money from your income for Social Security taxes, Medicare, Medicaid, all those things, that's not government spending. That is a transfer payment. That's where they took it from one segment of the economy and put it in the pockets of another segment, not necessarily government spending. So it falls into that personal consumption. Now, the fourth one is called net trade, net exports. And typically it runs against the United States because we have a tendency to import more than we export. Now, there's some nuance around there, but here we're looking at GDP. We saw that one of the fundamentals was against is slowing population growth. Here is a fundamental that's working in our favor. For all the different issues that we face, we saw on the fourth quarter of 2021, $24 trillion of economic activity occurring. Now, underneath, you see the second line, that's adjusting for inflation. That's kind of an important thing to think about, but nobody lives in the inflation adjusted world. We all live in that top line, our checkbook world, so we call it. So why is this good news for us? Well, today we see we're limited up again on corn, soybeans, and wheat. And we're seeing record high prices in some of these categories. But is $7 corn a price stopper in an economy with $24 trillion of spending? The answer is no. So one reason to be very bullish, though to be also aware because of the inflation aspect, is we have a lot of economic activity going on. So when we talk about agriculture's role as a subsystem within the bigger the economic system, we have to remember it's doing very well right now. Of course, nothing's a free ride. I mean, we have a lot of issue with government debt, we have inflation issues, we have productivity issues, things that have to always be addressed and thought about. But the top line, which is right there, is $24 trillion spending. So $7 corn that we saw back in 2012 is not the same issue that we see in 2022. Think about that. Go back to 2012 when we had the last big run up in corn prices with $16 trillion of economic activity. Today we have $24 trillion of economic activity. So $7 corn slots into that economy in a much better way. So I don't expect to see a lot of demand destruction around the pricing of corn and soybeans and wheat. Nobody likes it on the consumer side, but they have the money and they can spend it. So a little bit more on the economy before we step into the ag piece here. So how are we doing on the labor piece? Because it's interesting, if you look at this slide, everything looks hunky-dory, to use that old expression. But when we look at the payroll piece, we still have some big issues in front of us. Right before COVID hit, and we were just chugging along, we had 52.5 million people on company payrolls. Today, we still stand almost 3 million down from that level. So the real question is, where did those 3 million people go, and who are they, and where are they? Will they come back, and when will they come back? Well, what we're seeing, I think, is good news. We'd like to see it happen faster, but every single month we get another 300 or 250,000 or 400,000, depending on that month's number, of additional recovery on payroll. And as we get those people back to work, because we're not offering incentives not to work, and pay is better, jobs are plentiful, we see kind of an unkinking of some of the supply chain issues that we've seen. Now, it's not happening overnight. We'd like to see it faster. But the good news, when you look at this time series chart, is we had an incredible shock. So trend, cycle, and events. We had an incredible event around COVID. Now we're moving back onto trend. 2022, 2023, unless something really bad happens, and we can't see black swans because by definition, they're unforeseeable. We should see this unkinking in the supply chain. So there's a lot of good things going on underneath the surface, but the money is there, but the jobs are still building back. Okay, let's talk a little bit closer to your home. One of the really great benefits that I have in my position is that I talk to a lot of people across the entire spectrum of agriculture and food. You know, so I'll talk to companies like Domino's Pizza, you know, they buy a lot of cheese. They want to know what's happening in the dairy side. And then if you talk dairy, you want to talk feed costs. We talk to a lot of people on the input supply side. And so we kind of span that. So let's talk about where you're at and some of the adjacencies. Who are you connected to? What's the flow through the system? So I'm using this representation. And everything, you know, all models are wrong. Some models are useful. Hopefully this is a useful model to kind of help people say, oh yeah, I understand that. So I put farming here in the middle of this mosaic. But what is the flow through this mosaic? Let's think about that, because Elsevier is helping you with this flow. So there you're at farming. But farming needs three major pieces in this representation. You need the land, hard to produce things without land. You need the crop inputs. You know, my great-grandfather homesteaded in 1878 in western Minnesota. My cousin is still on the homestead. His son's taking over. He has a son that's looking to take over. So, I mean, we're talking 6, 7 generations. Now, my great-grandfather was happy to hit 20 bushel yields in western Minnesota in the late 1800s. Well, my cousin certainly isn't happy with 20 bushel corn yields, but he's depending upon a lot of technology to get him there. So that crop input side represents an important factor. We're going to talk about that because this is what we're talking about today. How do you manage this risk? Because it's a money ball. I'm going to come back to that phrase. It's a money ball world. So crop inputs, land, and then machinery. You can't do modern agriculture with antiquated machinery. And the question is, do you have the right machinery mix for what you want to accomplish? And did you get it at the right price? Okay, so it flows into your farm, and your job as a Moneyball manager is to put together the best team possible and then get them to perform. But then it moves away from your farm. You sell that grain to a livestock operator, you sell it to a food manufacturer, it goes to a livestock operator, then goes to a food manufacturer, and then moves to at home and away from home. Some of that corn and soybeans are flowing into the biofuel sector, flowing into transport. So there's a flow through here. So it looks like it might be a one-way flow, but it's not. We know there's a feedback loop that's kind of dispersed, but it's still impacting us. So what's the money today? The USDA comes out 3 times a year. First part of February, then in September, October, and then in December for final cleanup. And what we're seeing here is their first estimate for 2022. Things are good according to the USDA. Now, having said that, when I go to California or Oregon or Washington, where they're having more of a drought situation and some of their key crops like almonds and pistachios are starting to see very strong weaknesses due to trade issues, they're not seeing it the same way. This is really a Midwest-centric drive. But what we're seeing here, let's go back to 2012 versus 2022. Back in 2012, we had record crop receipts at that point, $232 billion. And we had about $170 billion of livestock receipts. Today, $249 billion is the first estimate, probably get moved up some of this pricing we've seen, and $213 billion for livestock receipts. That's $60 billion of additional cash flowing in to the farm segment. But now look at that net farm income at the bottom there. It's not that it's proportionally gone up on top of that. There's a lot of issues, the NPK, the crop rent, cash rents, machinery. There's no free rides here because everybody's playing Moneyball with us. They know what we're getting. They also want a piece of that. So the question and why you work with a co-op like this is to make sure you get the best deal that you can and then execute on it. But $60 billion top line is going to have a major impact. So let's stop and talk about livestock. I don't know how many people are connected to livestock, but it's a big part of our economy in agriculture. And we can see that right now, it's a pretty strong segment. We're looking at $102 billion, that primarily from the cattle and the pork side, then $53 billion in the poultry and eggs, and $51 billion in the dairy side. So we're seeing pretty strong receipts being driven by the consumer paying higher prices. Now, as this goes stronger, hopefully in the future, we see the opportunity to do better sales as inputs into that segment. Stop and take a little detour here. Let's talk balance sheet for a second. I'm not surprised. I know farmers. Farmers are in love with farm ground. They love it. You know, ranchers want more ranch ground. And it's interesting when we think about the balance sheet of the farmer, about 82 to 83% of the farming ranching balance sheet for assets is farm ground or ranch ground. Overwhelming. More than 8 out of $10 is in one category. So your financial well-being, your wealth component is driven by that asset class. Now, the next one down would be machineries and vehicles. And you can see that just kind of grows. It's kind of an input into it. It flows in and it flows out through utilization. And when I'm being kind of a wag, I would say that one of the best things that's happening to us this year is there's no pickup trucks go by. We're going to have to make do with a 3-year-old pickup truck so we don't spend more money on pickup trucks. Because there's a tendency to want to take that money and avoid taxes by buying that machinery or buying something that you can expense. But the question is, did you buy it for productivity or did you buy it for tax purposes? And there's something you really want to have a good conversation with one of your trusted advisors about why the spending and what do you expect it to do for you. But let's flip back and talk to the land. Early 2000s, we thought there was about $1 trillion of value in farm ground. Today, $2.7 trillion. And this is pretty conservative. Everybody on the Zoom call today knows what happened. About September of 2020, when we started seeing some checks from the government and we started to see better pricing on the board, the land market just clicked the switch. We know that land prices just really started walking up and they haven't settled back yet. They will. Land is a very cyclical market. Now, it's not a crisis. It's just a question of what do you buy and when do you buy it? Farm ground is a great asset, but it's a better asset if you buy it right at the right time and for the right reasons. Now, we're not unique and special. We're part of a bigger economy. And part of our borrowing costs, which drives that run up in land value, think about this, it's also driven to some degree by this. We can borrow money, have been able to borrow money recently for 4% for real estate transactions. Now, who says this? What do you know and how do you know it? This is from the Chicago Federal Reserve. They have an agricultural economics that they've been doing for decades. And they're saying, hey, 4% is kind of the average right now for fixed real estate around agricultural land. But we know the Federal Reserve is just starting to come off their easy money stance. And they're going to start raising rates this month. And so we're going to have to say, what will this do? It's going to raise the price of borrowing money. How much? I don't know. How could I know? You know, the Federal Reserve is going to respond to the information they get going forward. But we do know that higher borrowing costs will be detrimental to a lot of asset prices, not just farm real estate, but a lot of things. Because you're going to have to cash flow it at a higher borrowing cost, just part of the business. So we'll talk about timing around this asset as well. Let's get back to one of the central themes. You know, one of the reasons why you work with the co-op here and work carefully, it's because you spend a lot of money and you want to make sure that you get the best pricing on what you're spending. So let's go back to the USDA's farm income statistics. So I'm going to take the same chart that we saw earlier, but I'm going to switch the line on the bottom, which was net farm income, to talk about intermediate product expenses. Well, what is that? Those are the things that farmers and livestock operators write checks for. So for example, we're seeing a big run up in intermediate product expenses. Might be even a little bit too optimistic. It could be higher because we've seen a run up in the fertilizer market in the last couple of weeks from what we thought were already very high prices. But think about the impact between these two. A big part of the animal and products cash receipts is their spending on feed, corn, soybean meal, DDG, alfalfa, hay, whatever it is. So as we run up crop receipts, we necessarily run up their expenses as well. So these two are highly correlated. And secondly, as I mentioned earlier, going back to the mosaic of adjacencies, it's not like the Cortivas of the world, I'm not picking on them, but or the Bears of the world don't know that you guys have cash. They're as attuned to the market as you are. And they're saying, hey, if they have cash and we bring yield, we want to get paid for it. Okay, that is a competitive challenge between the two tiles of that mosaic. Your question never changes as a Moneyball player. And I'm using that term Moneyball because I love the movie Moneyball. Because when you think about that, the Oakland A's changed how they thought about players. They said, what do they produce for us and how do they produce it and how do they all fit together? And that's the same thing that you need to be as farmers. You're Moneyball players. You're saying, what am I buying? Why am I buying? How does it fit together? Who offers me the best price? And do I use it well? It's no good to have a star quarterback and then have a pathetic offensive line. That's the Minnesota Vikings approach to the world. You know, if you have a good quarterback, but he's running for his life at the hike, I mean, you're in trouble. So as a farmer, you understand that Moneyball approach. Buy it right, use it right. So we see the intermediate cost running up because it has to. But let's talk about trends versus cycles and risk management. What do you know and how do you know it? One of my favorite phrases. What we know is we go through cycles of profitability in agriculture. This comes from the University of Minnesota, my alma mater. I'm a big fan of it. It comes from the Center for Farm Financial Management. They have about 3,500 farmers that participate in this database. In fact, some of the people on the Zoom call today might be part of that. And what they do is they submit their P&L and their balance sheet, and they spread that data. They say, oh, how did you do against what do you own? And here we see two things. We're going to walk over the last decade. We don't have 2021 yet. They'll be coming out probably the next month or so. But we can see that we go through periods where we have extraordinarily good profitability in agriculture, and then periods where it's just very difficult. So there's no average here. So go back 2010, 11, 12, great years. And then we're starting to see the reemergence of this cycle. I have to be brutally honest here. This is only a cycle. This is not a new normal. We will see a struggle for profitability maybe 2 or 3 or 4 years down the road, just like we did from that peak to that trough previously. It's the nature of the beast. So the key issue that you have today is, how do I say no strategically to bad ideas? Because when you're flush with cash, there's a tendency to lower that criteria, your ROI, your returns that you need. And you say, I have to do it. This is a time where no is your best friend. 2015, 2016, when things were horrible, yes was your best friend. So yes and no, take turns being your best friend. There's never one or the other. So let's talk about ground again for a second. Here's a metric. This is something you don't look at day to day. I'm going back to the University of Minnesota database, trend versus cycle. So what we have here is I looked at the cost of producing corn versus what you were paid for it. And they're all in, all out basis. So when it's under 1, life's tough. You were putting more into a bushel of corn than you were getting paid for it. That's no good. You can't stay in business when you put more into a bushel of corn than you get paid for it. And you can see all the way back to 1996 to basically 2005. It was a grinded out scratch business. But having said that, you would have been best buying a lot of farm ground in 2001 when everybody was depressed as heck about farming. When would you have been worse off buying? 2012, 2013, when everybody was flush with cash. So here we're going through another upcycle. What do I expect to happen? 2021 will be a great year. 2022 will be a good year, and then we'll cycle back down. I want to really talk about that strategic idea of saying no when everybody else is saying yes. Really hard to do. Easiest way to double your money today is to fold it over and put it back in your pocket when it comes to land purchases. Nobody wants to hear that because it's burning a hole in their pocket. But let's dig a little deeper. This is from 2020. We'll get the 2021 data, like I said, in the next month or so. Even though it was a great year, not everybody did well. And some people did even better than average. So what we're looking at in this table is we're splitting that performance up into segments of 10%, from the worst to the best. A lot of reasons. You know, might be crop mix, might have been weather issues, might have been livestock versus crop, whatever it was, but there are a lot of things happening in these 35,000+ operators in this database. So yeah, we had a great year. We had a 7% return on assets. That's well above average in agriculture. We had a 20% operating profit on average. But we still, on the bottom left-hand side, we had a lot of people who didn't do well that year for whatever reason. And then we had people that did better than Apple did. I mean, talking about profitable corporations, they beat Apple by being farming or livestock. So what has to happen? In agriculture, the right-hand side with all this returns wants to take assets from the left-hand side. So when things are good, they have to be great. There's just, you can't have a good year when things are great. You got to make them even better. Returning to the theme of Moneyball. I mean, today I want to be cognizant of the time, but this is something that's been happening for decades. So the USDA looks at farm spending, looks at crop production spending, and they break it into 3 big buckets: labor, capital is primarily machinery, not land, and then intermediate purchases, things from third parties. And so what we're seeing here, adjusting for inflation, is a radical change in the nature of agriculture. Post-World War II, it was a labor-intensive industry. Today, it is an input-intensive industry. So Elsevier is helping you guys by saying, hey, we're going to find the right suppliers at the right price and bring it to you. That's what a good co-op does. They are negotiating those treacherous waters out there for availability and pricing. So you can see if you're not focused on the ag spending for intermediate purchases, you're not focused on the right thing. You know, the old joke is, you know, Willie Sutton, a bank robber back in the 1920s, they caught him. And then, you know, they said to Willie, Willie, why do you rob banks? And Willie said, because that's where the money is. This is where the money is. The money is in those inputs. And so what do you buy? When do you buy it? How do you use it? Are the keys to your long-term success. Let's look at this a little differently. I'm going to break this down. A production function is kind of a recipe. What do you put in for what do you get out? And how can you change that recipe to change what you get out? Well, corn farming has a recipe. What I did here is go back, you know, you get blinded by the dollars, so to speak. The spending that you had in 1996 has nothing to do with the spending you had in 2020 or 2021 or 2022, because the dollars grow. But how they get allocated is a very interesting component. So I went back, I said, what did you spend? What did you get for corn? And what percent of your yield, because the yield's also changing, trending up over time. Where did you put it and why did you put it there? Let's look at corn, just as a good example. You can see a couple of things, structural change. Take a look at the very bottom there, crop chemical and seed. See how they diverged? It used to be you spent about the same amount of money on seed and crop chemical. But we all know what happened. We embedded more technology into the seed and then didn't need as much crop chemical, but they work together. The spend between the two is pretty much the same as it was previously, just different pockets. The other thing we notice is we go through big cycles. Early 2000s, cash rents were extraordinarily high. Why? Because crop prices were low and they didn't adjust for that. Then we saw that chase where we saw cash rents go up and up and up, but they were always lagging behind the increase in crop prices. So the landlord got less and less and less of the corn yield. And then we had the great rebalancing of 2013 and 14. So we go through big cycles. Fertilizer goes up, fertilizer comes down. Look at 2020. The share that was given under the crop input study done by the University of Minnesota meant the farmer did very, very well. There's a reason why they had extraordinarily good returns. They only gave the landlord 25%. Long-term averages between 30 and 33%. They only gave machinery 17%, typically 19 to 20%. Look at fertilizer. Fertilizer dropped to 15%. That seems pretty cheap in today's world. Then 13% for the seed and 4% for the crop chemical. So it's one of those deals we get so often where we price the inputs 1 year and then sell the corn the next year. And it's not always guaranteed to work together. So going back to the theme of risk management, what are you doing to make sure that your opportunity sets align? Now, I'll guarantee you this, to give away risk means you give away reward. I mean, personally, you know, I know this, I sell stocks too soon, you know, in hindsight, you know, I say, oh man, that price for the petroleum stock is good. I'm going to take it. I didn't think to get that kind of return. I sell it, and then for the next 2 or 3 weeks, it goes way higher, and I want to kick myself. That's no way to do business. Absolutely no way to do business. You have to talk about managing returns against risk. And that's why you want to work with your cooperative for those opportunities to balance the two inputs. Took a snapshot a little while ago. We know that fertilizer is completely out of whack. Over the last 10 years, even with all the variability we just saw, we're going to zoom back on it. Typically, you give 19% of the corn away to get your NPK covered. Right now, when I took a snapshot, we went from $125 in 2020. We'll get the 2020 numbers, like I said, recent in a little bit. We're already up to $400 an acre under this prescription. I'm not an agronomist, but it's in the ballpark. And what we can see is now you're giving away 33% of your corn yield on spot versus spot opportunity. That won't work. So The problem is it's not going to work. It's going to change. But in the meantime, what do you do with it? And the answer is, my mind is, you don't go crazy. I mean, if you have spot needs to cover, you cover them. And it's a big penalty on that component. But hopefully a lot of people got fall applications on and they had pre-purchases. So they're not in that situation spot on spot. And you never are. That's where the blending of risk comes in as a key element. Let's talk a little bit about that. Talk about risk management. I'm a big fan of crop insurance. And here, let's drop out the land, drop out the machinery, and focus on 4 pieces here: seed, fertilizer, crop chemical, and crop insurance. Going back to that same idea of what do you spend for what do you get? Now we can see it's interesting that 26% to fertilizer in 2013 and 2014, we're kind of back in that situation here. But look at that crop insurance, just hangs around 3% all the time. Why? Because it's designed to. We designed the pricing mechanism to have that spring price, which we're calculating, to represent what our risk opportunity is in crop insurance. Typically, farmers in this database give away 3% of their crop to get their crop insurance. That's a good deal. That's less than their crop chemical. Now, it's a better deal if you use it, because if you're marketing against that guaranteed income, you're sure to give away some early sales that you regret later, and sure to make some early sales that you love later. But you're certainly allowed to get yourself managed better in terms of the risk reward that you have out in front of you. How long will these stronger prices stay? You know, that's an unknowable. That's one of those things where you can give a lot of rationale, and there's a lot of things, good things happening. We had a supply shock back in 2019 that wasn't recognized by the market properly. It took 2020 to get the market to wake up to short stocks. China's back, both on corn and soybeans, drought risk around the globe, the conflict in Ukraine and Russia shutting off competition, the ever-increasing demand for protein, both domestically and in growth markets, and then ethanol demand, which has come back from the COVID shock. But it will face a headwind going forward. So there's a lot of pieces. I mean, you could spend days talking about this. But once again, trend versus cycles versus random events. So what's the right price for corn? What should you be paying for farm ground based on the next 10 years, not on the moment? Hard to say, of course, because we get wrapped up in the moment. Back when we had 2011 through 2013, $6 to $7 corn became the new normal. And we're certainly moving back in that direction right now with what we're seeing. But then again, we saw an incredible cratering in 2013 and 14 and 16, where we really saw those input prices priced on last year's price really damage our balance sheet. We're trying to say, how do I avoid that? Where do I make my agreement? And when do I lay off my risk against that agreement so that I don't have a cratering, so I don't see that drain back out on my balance sheet? You know, the market's always adjusting. There's always new information. And trend versus cycle. Here I'm going to put corn and soybeans together because it's the same market in my mind. We don't plant corn, we're going to plant soybeans. We don't plant soybeans, we're going to plant corn. It's just the way the world works in the upper Midwest. And we can see we're just trending up on better yield, more acreage. But we have certain major events like the 2012 drought, the wet spring of 2019, and all the issues around there. But are you going to bet against the trend, or are you going to know the trends there and then work around it when you see those opportunities, either pro or con? So why is the market so worried right now? It's because we don't have a lot of safety stock. As simple as that. I used to work for Cargill down in South America as a grain trader a long time ago. And, you know, I learned there's only 2 emotions in the market: fear and greed. And basically it's fearful greed is what we deal with most of the time. But right now we're still on the low side of these historical ranges. So we should have a pretty good risk premium in the market. It will go away. It always goes away. We see demand destruction and we see supply growth from markets that can do it, including ourselves. Took this snapshot yesterday, so it's way out of date. But here's a problem that the market has. Why do people want to buy corn at nearly, $8, $7 a day and hold it as it gets less valuable? That's not a typical carry that makes you money as a grain trader. I mean, typically you want to buy something today that's getting more valuable and more valuable than the cost of storing it. To buy it today for more than you're going to sell it for, plus the cost of storage, is not a market that can work for a long time, because you simply kill the grain trade. You simply kill the ability for those people to make money doing it. And if people don't make money doing something, they stop doing it. So will it change radically? It's a tough question. Let's go back and look at history. There's an equilibrium, there's a thermostat in the market, and basically it's 2.5 times. So soybeans are 2.5 times the price of corn, but they're never exactly 2.5 times the price of corn. So when we look at the futures board today, take those contracts that are out there, say what's corn, what's soybeans, right on that mark. So it's really hard to say, hey, the market's bidding up soybeans, or saying, hey, don't do corn. Maybe with NPK, people are thinking those things, but it's tough calculation. The market's not, hands down one or hands down the other. It's kind of putting this down the middle of the fairway. So what should you do about it? Respect the market. The market's going to change its mind. You got to take advantage of the opportunity, but respect the market. 10,000 fighting fools at the Chicago Board of Trade. There's probably a lot of wisdom in there, plus a lot of madness. China's always a big deal. I'm going to finish up just a little bit here. We saw China come out of nowhere in this corn trade, and we're still saying, are they going to take their agreements? Are they going to cancel orders? What's going on? And that's a tough question. It gets back to the idea of a permanent versus a transitory change. So let's talk corn and soybeans from the China side before we finish up here. China produces a lot of meat, and they've really gone all in on corn production. You can see it went from 100 million metric tons of corn back in 2000 to about 250 million metric tons, but they've plateaued over the last 5 or 6 years. Why? Well, a lot of things going on there. It's probably a price incentive from the government. They're probably not giving them the price that would incent them. They haven't allowed a lot of modernization still. We still see very small farms in China that can't really take advantage of the technology that you guys are applying. So some headwinds there for them in terms of production. There's still only about 40 to 45% corn yields versus the US. And of course, they can buy our technology. They can buy our equipment. So they have a lot of upside potential on the same amount of ground through yield. So it's a lot tougher as a front runner like we are to move further ahead than somebody who's drafting at your back. But look at the corn net imports. When you put them in perspective with their production, they're important, but they hardly rock their world. They kind of use them as a shock absorber. Now let's look at soybeans. Soybeans is a completely different animal. They basically put a lid on soybean production back in the early 2000s and turned to the global market saying, hey, North America and South America, they have soybean growth. They're willing to sell them to a price that's better than we can produce it at. We're going to use our domestic resources for corn, for squash, for high value crops. So they've been a big increase in the global supply. But at what point do they plateau around here? China's population has peaked and starting to decline under some estimates. Under any estimates, peaking right now or peaking in the next couple of years. There's no two ways about it. Their meat consumption is pretty robust as is. Could grow more, of course, but not like it did through the 2000s and early 2010s. So at what point do we get a shift in this dynamic as well? A lot of things going on that we want to think about under risk management. How about Russia and Ukraine's role? Topic that we have to address right now. Mainly going to Middle East and North Africa. Compete for the same markets. The EU buys some corn from Ukraine. When you hear it's the breadbasket of the European Union, it's not true. They spot buy corn from the Ukraine. China buys from the Ukraine. They'll need to replace that if it's not available. A lot of issues around their acreage, their yield, their handling. So Russian wheat, they've come out of nowhere. I mean, basically they were just pathetic and they stopped being pathetic. They're a big producer. So the blue line is the gray line is global wheat production, about 800 million metric tons. So you can see the Russians are a big piece at 86, about almost a little plus 10%. Ukraine, not so much, because Ukraine puts more against the corn piece. Here you can see on the corn side, once again, the gray is the global number. So about 1.7 billion metric tons. So neither one is a big player in those markets. So yeah, they're important, but you also want to keep a little bit of an idea around there. So I'm going to stop there. We're at 11:50. Ashley, how do you want to cover questions? Is there a Q&A box, or do they want them just to unmute themselves? What's your preference as our web host?
Yes, thank you, Michael. If you want to enter them in the chat box, that would be fine. And then we can read them out loud as they come in. So if there is any other commentary that you wanted to add, go for it. Otherwise, we'll give people a few minutes to add their questions. And if once we get those finished up, then we'll push you all to your breakout rooms.
Sounds good. Yeah. I mean, and let me say it's a pleasure. I mean, it's really easy to talk about what farmers should do when you're sitting at your kitchen table. I mean, it's a lot tougher when you guys are in muddy fields. So don't think I don't appreciate that. Whenever I give advice to my cousins and my nephews, they take it with a grain of salt. So you should too.
Oh, we do have one question that came in, so I'll get that to you here, Michael. If Russia and Ukraine war stops, how will the markets respond?
Oh, we know that answer. They're going to take that risk premium that they just put into the market right off the table. They'll assume that the flows will go right back to normal. And so, it's a good question, because do you want to take this current risk premium or think that you might be offered a higher one? And I would go back to the 2008 environment. We heard those tales out of North Dakota, where we saw hard wheat go into the upper teens, for a few trades. And then that made everybody rethink what they wanted for a trade. But the number of loads that got traded at those prices was ridiculously small. And I remember going up afterwards to North Dakota, and one of our wheat farmers told me that he had wheat in the bin that either had to go to kindergarten or get sold. I mean, you don't want to be sitting on wheat for 5 years. No. So yeah, they'll take the risk premium off the table. So the question is, do you want to sell a few loads at this current risk premium, which I'd say it looks pretty attractive if you're going to grow it.
Great. And then lastly, how should a person protect the bushels they have sold from earlier in the year?
Well, hopefully, you have the crop insurance. Make sure you don't miss that piece. This is a good year to think about that trade. I run into it a lot. I mean, crop insurance is your only subsidized input. It is your premier marketing tool. It gives you that assurance that those early sales, which were profitable, will be there no matter what happens. And I know it's tough to write the checks. Those premium checks are not easy to write, but you really want to go back and talk about bushels to bushels and the upside potential. Because think about it this way, only the government's going to sell you a call option built into your crop insurance for the price that they do. If you want to go buy a call option today, boy, you'd be paying a huge premium. So I think marketing starts with the crop insurance piece. And maybe if you're moving up 5%, maybe if you've been at 75% coverage level for the last 3 or 4 years, you move to 80. Maybe if you're 80, you move to 85. I mean, if you've been an aggressive marketer, you might want to look at some of the third-party options. They're much more expensive, but you can move up to closer to 100%. So think about it as a marketing expense versus trying to buy calls or buy puts. Buying puts right now would be very expensive. So when you price it Moneyball, think about buying that risk protection from those two different resources, one right off the board from the Chicago trade versus what the government's willing to sell you built in to the spring price into the fall option pricing that you get. That's going to be the way to get forward and make those sales. And then in 2023, have no regrets about it.
Michael, what do you think the influence of the dollar going forward looks like?
Right now we're benefiting from a couple of things. The dollar is strong, which is not good for agriculture, for exports. We're seeing a risk to security, a flight to security. So we're seeing dollar strengthen around there. And we're also seeing the Federal Reserve, like I said, moving rates higher. So as the Fed takes us off of 0 for the short term, and we're seeing the 10-year Treasury walk up to 2 where it has been waffling a little bit the last few trading sessions. But as it moves up under that inflation constraint, the dollar's going to strengthen. That hot money always moves to where it sees security in return. And so Ag's going to have to deal with a stronger dollar in some of these key export markets. So the two things are always related. So a strong economy is our number one best bet, having strong consumers. But we will see a strong dollar around those flight to security and better returns on a risk evaluation in the trade market.
Okay. You had mentioned increased global demand for protein. Does an increased demand for protein influence the price of corn or soybeans more?
You know, they're kind of together, I'm going to say. There's one dynamic that's kind of breaking out right now, and we've had the West Coast lead the Renewable Bio Initiative. So we're seeing a real demand for soybean oil going into that low carbon biodiesel, but it's really hanging over the market with a lot of crush for the soybean meal. And so it's very interesting to see how the crushers have kind of flipped themselves. They used to follow the meal market more, now they're following the oil market more. So when it comes to protein, it's basically that recipe over and over again. You need the carbohydrates and you need the protein, especially into the pigs and the chickens, which are going to be the growth animals going forward. So I would say there might be periods where the two move apart, but they got to move together. That protein needs them both. So we're lucky there. I mean, otherwise we'd get kind of stuck with the excess of one.
Mm-hmm. Thank you. A follow-up question to when you were talking about crop insurance. Crop insurance stops at 200%. How do we protect beyond that?
200% is pretty good. I mean, then you might have to step into the private market. I mean, the crop insurance companies typically have, you know, programs that they sell that you have to evaluate carefully. Obviously, they need to make money overall selling them, but as risk instruments, they do have their options. Or you can look at buying calls. I mean, like I said, how far out of the money? This is not the time to get into it, but you should think carefully about what they say a covered call strategy. If you're going to be long something, you have the ability to sell a call against it. You give away some top side, but you also become an insurance broker for somebody else. So do some research around there. Think what it means to you on a covered call strategy. It's worth investigating and thinking about.
Okay. And then the last question we have is, how would an escalation in conflict, including more countries, impact the grain fertilizer markets?
You know, the fertilizer is probably the biggest fly in the ointment. What would be interesting is to know what China's going to do. When we think about where we're at today in the world, I mean, Russia, Belarus is a huge component for the NPK market. But China's kind of really given us a reason to be concerned about their stability as well. I mean, when they withdrew from the market recently, I would expect high prices are going to tempt a lot of marginal producers to come back into the global market. And it's going to be true. I mean, we have resources in the United States that are offline because they weren't making money. At these prices, I think there's going to be a lot of global response and also a muting of some of the demand, some of the weaker markets. So I think Russia and Belarus will be out of the market for a while. It'll be interesting to see whether China plays nice in this market as well. I'm not going to hold my breath, but it's important.